What's up, hungry investors? Welcome back to the channel. Today, let's zoom in on creative financing, one of the most powerful tools in your arsenal during periods of high interest rates. As traditional lending becomes more restrictive, savvy investors are finding innovative ways to structure deals that maintain profitability and minimize risk. Here's how you can turn the challenges of today's market into opportunities with creative financing. Number one, seller financing, a win-win for buyers and sellers. Seller financing, also known as owner financing, allows the seller to act as the bank, offering a loan to the buyer directly. This method is particularly useful in today's environment for several reasons. Lower interest rates. Sellers may be willing to offer rates below current market levels, creating immediate savings for buyers. Flexible terms. Negotiating payment structures, such as interest-only periods or balloon payments, can improve cash flow. Solving seller challenges. For sellers struggling to offload a property, offering financing can make the deal more attractive without a significant price reduction. Imagine you're targeting a property owned outright by a seller nearing retirement. They might prefer consistent monthly income over a lump sum, giving you room to negotiate terms that align with your investment strategy. Number two, joint ventures and equity partnerships. When borrowing costs rise, partnering with other investors can help spread the risk and share the rewards. Pooling resources. By combining capital with like-minded investors, you can tackle larger, high-quality deals that might otherwise be out of reach. Shared expertise. Partners can bring different skills to the table, such as market knowledge, asset management, or legal expertise. Reduced financing needs. With more equity in the deal up front, you can minimize reliance on traditional loans, reducing exposure to high interest rates. Pro tip: be selective about your partners. Align yourself with individuals or groups whose investment goals and timelines match your own to avoid potential conflicts. Number three, assumable loans. Some properties come with existing loans that are assumable, meaning you can take over the current loan rather than securing a new one. This is a gold mine if the loan carries an interest rate that's lower than today's market rates. Lower borrowing costs. Taking over a 4% loan in a 7% interest rate environment gives you a significant competitive advantage. Streamlined process. Assumable loans often simplify the financing process, making transactions quicker and less complex. Be sure to review the loan terms carefully and ensure the property's performance justifies the remaining debt. Number four, lease options and master leases. A lease option allows you to lease a property with the right to purchase it later at a predetermined price. This is especially useful for investors with limited liquidity or those wanting to test a property's performance before committing to a purchase. Reduced upfront costs. Minimal capital is required to control the property while you assess its profitability. Cash flow potential. You can sublease to tenants, generating income while delaying the purchase decision. A master lease agreement, on the other hand, enables you to lease an entire property and take over operational responsibilities, often in exchange for the option to buy at a future date. It's a fantastic way to reposition underperforming assets without a large initial investment. Number five, mezzanine financing. If you need additional capital to close a deal, mezzanine financing can bridge the gap. This hybrid of debt and equity often comes with higher costs, but it can be a lifesaver for well-planned projects. Increased leverage. Mezzanine financing allows you to fund up to 90% of a project's value while preserving your equity. Flexible payment. Lenders are typically more willing to work with you on repayment terms since their returns are tied to the project's success. Number six, crowdfunding platforms. Technology has revolutionized how we fund deals. Real estate crowdfunding platforms connect investors with opportunities to fund projects collectively. Diversification. Invest in multiple properties with smaller amounts, spreading your risk. Passive opportunities. Many platforms offer deals where management is handled by experienced operators. Popular platforms like Fundrise and CrowdStreet cater specifically to commercial real estate investors, providing transparency and access to deals once reserved for institutional players only. Number 7, tax-deferred strategies. 1031 exchanges, while not strictly a financing strategy, leveraging a 1031 exchange can be a game changer in high-rate environments. By deferring capital gains taxes on the sale of one property, you can roll those proceeds into a new investment with minimal out-of-pocket expenses. Maximize capital. Keep more of your money working for you rather than handing it over to Uncle Sam. Strategic upgrades. Transition from underperforming assets into properties with higher growth potential or more stable returns. Why creative financing matters more now than ever. Rising rates are a test of an investor's adaptability. Traditional strategies won't always cut it in today's market, but creative financing opens up a world of possibilities. Whether it's negotiating directly with sellers, forming strategic partnerships, or leveraging innovative tools like crowdfunding, these methods allow you to maintain momentum and capitalize on opportunities that others might overlook. Remember, the name of the game is flexibility. Staying open to unconventional approaches not only helps you survive challenging markets, but it positions you to thrive when conditions improve. Signing out for now to go sign up some more deals. If you made it this far through and you landed here, it means you're serious about making money in commercial real estate. Don't forget to hit the subscribe button if you're not already following for more great commercial real estate, and check out this video or this video. As always, stay hungry, my friends.